Hello, everyone. Greyson Geiler here with SES Services, providing for you weekly market update. We like to take some of the headlines from the financial news and go a little bit further into depth. And today we're just going to talk about, hey, what do we think is going to happen next? Okay, so the $1 million question now is what happens next? Um, Last week we talked about a pretty impressive rally in all the asset markets, bonds, stocks included. And I think right now this week it's a really good time to take a step back and let's analyze where we are from 10,000 feet. I mean, you rewind a year ago and we had a wildly aggressive Federal Reserve with its foot on the accelerator, interest rate still zero. Fed was buying $120 billion worth of assets on the open market every week between treasury bonds and mortgage-backed securities. They were still doing that a year ago today. And now, fast forward a year, and we have a wildly aggressive Fed not tapping the brakes, really not even stopping on the brakes, standing on the brakes, with aggressive interest rate rises and removing the entire support system of $120 billion a month in asset purchases. I mean, I have to keep a check sheet together to remember all the wild stuff going on out there right now. The Russia-Ukrainian war. We're talking about supposedly bombings around a Ukrainian nuclear plant. We've got China struggling to come out of their lockdowns. Their bond market is turned around as the Bank of China is pouring some liquidity on the game, and other central banks are tightening rates. Again, we've talked about in the last few weeks, the Federal Reserve bailed out Credit Suisse. Bank of England had a big challenge with some of their gilt pricing. Looked like that was going to spiral down, and they had to bail out pension funds. I mean, we've had these inflation numbers that are crazy. I mean, I have to keep a list. Well, now we have the meltdown in crypto world, and people think, well, that's just a fringe asset. Who really cares if the cryptocurrencies come apart? People are losing billions of dollars. Billions of dollars are going up in smoke. So that's not just a poo-poo, nothing else going on. So of course I keep talking about Japan. Japan is literally staring over a deep and dark abyss, monetarily speaking. And now we've got a candidate vying to head the Bank of Japan who says his protocol is going to be to remove Bank of Japan emergency procedures supporting these markets. And that just seems absolutely crazy to me. Japan is in a constant emergency right now. The Bank of Japan is the only buyer of Japanese government bonds. They own 60% of the entire stock of Japanese government bonds. The Bank of Japan does. And they're the only one buying right now. And the reason for that is they've put such a high price on these bonds that they'll pay corresponding to such a low interest rate on the bonds. No one else will pay that price for the bonds. So if the Bank of Japan, if this guy does get the chairmanship and starts removing the Bank of Japan bids, you're talking about the fourth largest economy on the planet with their credit markets frozen. It's some really wild stuff going on out there right now. So, I mean, at this, you get the point. So the big thing that I wanted to talk about today, we alluded to it a little bit last week, is with such a wild rocket launch in the stock market over the last few weeks. Now, and we were adamant that we thought the negativity out there in stock prices especially was overdone. Well, now after a rocket launch like that, I don't have that same conviction. Especially when you look at interest rates. So What you're looking at right now is a long-term chart of the 5-year Treasury bond yield, Treasury note yield, excuse me. It's the bonds are the 30 years. So you see quite an aggressive, I mean, you're looking at March, April, May, June of 2020 at the very bottom here. And the interest rate was, 0.3. And we have just in a year and a half, we have rocketed over 4%. And you go back, we're talking about a rate on the 5-year that we haven't seen till in front of the 2008 bomb. So it looks like the interest rate got shot out of a cannon. I mean, reminiscent of the late 70s for what we've got going on in the rise in interest rates. And again, interest rates rising, asset prices in general are going to be valued lower. So if you're an investor, and again, look, I'm not saying everybody needs to go running out and sell all their stocks and buy a 5-year Treasury note. But with interest rates consistently higher like this, so aggressively higher like this, we do have to take a step back. And the valuation numbers on the stock market, you're going to get to agreeing that it's too expensive much more quickly when there's a cost of capital, when interest rates are going up higher. I mean, you can go buy a 4% 5-year Treasury. Again, not saying everybody should be piling out and doing that. But it does give us pause for concern with the great rally in the stock market. And we've said this a few times over the last few weeks. If you feel like you've had too much risk in the markets, now's a great time to reevaluate. Going forward, again, that's the $1 million question. But we do worry that if the Federal Reserve does come out and raise rates next month, which they're still slated to do, it might put the brakes on a Santa Claus rally. But we can't predict that perfectly. But what we can say is there's more and more danger in the financial world the higher these interest rates go. Again, something broke in Japan just over the last few weeks, few months. Something broke in Switzerland, Credit Suisse. Something broke in England with these higher interest rates. So we have to pay attention. The amount of bad debt in the system as compared to the late 70s is titanic. So it's quite apparent to us that the central banks of the world are prepared to bail out on a small scale the Credit Suisse type meltdowns. They'll be bailing that sort of entity out while interest rates continue higher. But does it get too much to where they can't contain it? Of course, we fear that. Even after all this talk and all this risk and all that kind of stuff out there, I look at the performance of the stock and bond markets just in the last few days, and it's still holding together quite well. And also keep in mind, by some measures, the bearishness is bigger right now than it has ever been. And that measure being the put to call ratio. Lots and lots and lots of investors, money managers are out there buying put options, which means they're buying insurance in case the value of stocks goes down. Relative to the number of people buying calls is at an all-time high. So there's still a lot of bearishness out there. Some of it warranted clearly with some of the craziness going on. Still, some of it may be a little bit overblown. We may get a Santa Claus rally. Just the risks are starting to go higher because interest rates still go higher and the price of the stocks keeps going higher. So keep all that kind of stuff in mind. Hey, reach out to us if we can help in any way, shape, or form. You've got our contact information on the screen there. Click like on the YouTube channel, click subscribe, forward this to any other people that you know may be interested. Be happy to sit down with you for a one-on-one consultation with regard to your financial situation. No obligation, no fees, no costs, no risk. Give us a call if you need some help. Hope you enjoyed today's presentation. We'll see you next week.